Welcome all the viewers. Dr. Vijay on accounting. Lecture number 1. PowerPoint slides are used. Thanks for attending till the end with total involvement. Let us go to slide number 1. There are two branches of science of accounting. Financial accounting, which deals with recording of transactions, and management accounting, which deals with estimation and ascertainment of costs. This series of lectures is on financial accounting. Now we are at slide 2. Stages of accounting process. Financial accounting process includes 4 stages. First, keeping record of transactions in journal books and ledger books. It is known as bookkeeping. In ledger book, there are accounts in the names of assets, expenditures and incomes, and of parties with whom the firm has unsettled dealings. Every account has debit side and credit side, and a transaction can be posted in either side. Every transaction is posted in the debit side of one account and in the credit side of another account. Now the third stage is summarizing the records periodically in the form of trial balance, final accounts and balance sheet. Next stage is analyzing the summaries as ratio analysis, cash flow analysis and fund flow analysis. And the last stage in accounting process is reporting the results of the findings and summary statements to all the stakeholders. We are with slide 3, accounting principles. Accounting principles are the foundations of modern accounting, followed by Accountants University. Some of them are known as concepts and others as conventions. The major principles are money measurement, dual aspect, separate entity, going concern, matching and materiality. Each one is explained in proper context in the course of the lecture. Let us see slide 4. Meaning of goods. Goods is the thing which is bought and sold by the trader. Trading stock or inventory. For a vegetable dealer, vegetables. And for a car dealer, cars. There are different day books and accounts in the ledger book for recording each transaction in goods. Purchases day book and purchase account for purchase of goods, say vegetable merchant, purchase of vegetables, sales day book and sales account in ledger for recording of sale of vegetables, purchases returns book and purchases returns account for recording return of goods to the supplier, and sales returns book for recording return of goods by the customer. A purchase of car for sale by a car dealer is to be treated as purchase of trade stock and to be entered in the purchaser's day book and in the purchase account ledger. But purchase of a car by a vegetable dealer for business use is not shown in purchaser's journal and purchase account. It is to be shown in general journal. Let us take slide 5. Transactions. A transaction is any dealing between two parties involving transfer of money itself or transfer of something the value of which is measured in terms of money. The terms used in definition are explained one by one. First is parties. A transaction takes place between two parties. Either party or both the parties may be an individual, a firm or a company or a government organization or an international organization, whatever. The second term is money. Money means the currency notes and coins in circulation in the country. The money may be paid, or remittance of money can be done in different forms today, through payment of currency notes and coins itself, or through checks or debit cards and credit cards, or through account to account transfer, or any other means of digital payment. Here, the transaction may be transfer of money itself. When you are borrowing money from somebody, there is a transfer of money. When you are lending back the loan, there again a transfer of money. So, a transaction may be a transfer of money itself, or something, the value of which is measured in terms of money. Unless the value of whatever is transferred is not measured in terms of money, it cannot be recorded in the account book, because the account book, whether journal or ledger, it has amount column. After entering the transaction of a particular column, its value in terms of money has to be shown in the amount column. Take the case of salary paid to the housemaid, $900 per month, say. It can be recorded in the account because the salary for the service of housemaid for 1 month is measured as $900, so it can be recorded. Whereas the service of the housewife, the homemaker, for whatever services rendered by her, nothing is paid. So value is not measured in terms of money, so it cannot be recorded in the account book. Barter transactions of the early days where money was not in circulation. It was exchange of goods for goods, but whatever is transferred, its value was not measured in terms of money. So it cannot be recorded in the account book. But even if it is exchange of goods for goods, the value of both the things exchanged are measured in terms of money, okay, it can be recorded in the account book. This limitation of accounting is known as money measurement principle. This is a foremost or fundamental principle of financial accounting. One more thing to be said regarding transactions. We have seen transaction is a dealing between parties. A dealing may be a transaction by itself, or a dealing may involve 2 or more transactions. Where you are purchasing something and making payment instantly, that dealing itself is a transaction. Where you are purchasing goods for $1,000 today and promising to make payment after 1 month, and you are making the payment as promised, then there are 2 transactions. One which takes place today, the supply of the goods. The other, the payment for that, which is done after 1 month only. Both are 2 different transactions. A transaction has to be recorded in the account books immediately after its occurrence. Without occurring, no transaction, nothing can be recorded in the account book. Okay, hope that you will make the payment after 10 months, after 10 days. You cannot record that it is paid. Or the other party cannot record that it is got. Only when it is paid and got, both the parties can record the payment in the account. We are going to slide 6. We have seen barter transactions cannot be recorded in the account book because value of what is exchanged is not measured in terms of money. Where it can be measured, then can be recorded in the account book. So excluding barter transactions, there are 2 other types of transactions: cash transactions and credit transactions. Here is a table comparing cash transactions and credit transactions. Let us see that. Cash transactions involves transfer of money, remittance. Unless there is a remittance, payment of cash, it is not a cash transaction. Credit transaction means purchase or sale of anything on credit. On credit means payment is not done currently. Payment will be done only on a future date. Purchase or sale of anything, maybe goods, other assets, whatever, and it is on credit. Payment is not done. Cash transaction means it necessarily involves transfer of money. When you are purchasing goods for cash or selling goods for cash, it is cash transaction, because even though it is two-sided transfer, there is transfer of money. Credit transaction means purchase or sale of anything on credit. There is transfer towards only one side. It does not involve a transfer of money. So we call it credit transaction. When you are borrowing money from somebody, it involves a transfer of money, even though it is one-sided transfer. So it is cash transaction. Or when you are repaying the money which is borrowed, that again is cash transaction. A cash transaction may be either settling an old debt, or creating a new debt, or curtailing or raising an existing debt. Credit transaction, it creates a new debt. It does not settle. You are only purchasing or selling goods on credit. It does not settle. Okay. Hello, we are with slide 7, journals or daybooks. Transactions are recorded primarily in the journal book, also known as daybooks. The entries are made in the order of their occurrence. In practice, in business firms, they use different daybooks for recording transactions of different nature. Different daybooks for transactions of different nature. We have shown here 3 kinds of transactions. 3 different types of journal books are used. See, first is cash book, for recording all cash transactions. All cash transactions are recorded in the journal book called a cash book. Then the second set is for recording credit transactions in goods. We have seen the meaning of goods. You are a car dealer, your goods is cars. So for purchase of cars, you will record in purchases daybook. For sale of cars, you will record in sales daybook. Any returns to the supplier, you will record in purchases returns book. Any returns from the customer, you will record in sales daybook. So there are different daybooks for recording transactions in goods. Now the last is journal or journal proper. That is for recording the residual transactions. Residual means it is neither cash transactions nor related to goods. If you have any such transactions, say for example, you are car dealer, you are purchasing furniture for office use. Purchasing furniture for office use, if you are making payment, if it is for cash, naturally it will come in cash book. But if you are buying furniture on credit, furniture is not your goods, so you cannot record in the second category of daybooks. So you will pass an entry in journal or journal proper. There are many other kinds of entries to be recorded in journal proper. We will study further. An important thing to be noticed now is, in the initial sessions of learning accounting, the learners are taught to record all the transactions in the journal itself. Means only one journal book you are using. All transactions you will record in that. It is in the initial stages of practice. That is done for familiarizing the student. Hello, we are taking slide 8, double entry system and dual aspect concept. From journal books, each transaction is posted in the ledger book in 2 places, in the debit side of one account and the credit side of another account. We have seen that. Because of recording in 2 places in the ledger book, this system of bookkeeping is known as double entry bookkeeping. It is based on dual aspect concept. Wherever somebody involves in a transaction, whether cash or credit, he gains value in one form, that is gaining aspect, and loses equal value in another form, that is losing aspect. For example, where A purchases goods from B for $1,000 for instant cash payment. Looking from the angle of A, he gets goods of the value of $1,000. He loses cash $1,000. So there is gaining aspect and losing aspect. Looking from the angle of B, he gets $1,000 and he loses goods of the value of $1,000. Now to take another example, where A purchases goods on credit from B for $1,000, A gets goods, that is gaining aspect, and A becomes a debtor to B. He becomes liable to B for $1,000, that is losing aspect. Correspondingly, B gets right to get $1,000 from A, that is his gaining aspect. He parts with the goods of the value of $1,000, that is his loss. So every transaction involves a gaining a value and a losing a value. Account book is a record of values, one's values. Unless both the gaining a value and losing a value, unless both of it is recorded, your record will be incomplete. This is our last slide in lecture 1, demonstrating ledger posting under double entry system. How transactions are posted in the ledger book, that we are studying first. How that is to be recorded in journal, we are going to study in the next stage, lecture 2. Here we are taking an example. A purchase of goods by A from B for instant cash payment of $1,000 on January 10. A purchase of goods by A from B for instant cash payment of $1,000 on January 10. How to post this in ledger? See, it is to be posted in the debit side of purchases account and on the credit side of cash account. It is shown there. Both the accounts are shown there. Look at purchase account first. See, purchase account is debit side, left hand side. Credit side, that is right hand side. In both the sides there is date column for recording date of transaction, particulars column for showing the details, journal folio column and amount column. On the credit side also similar columns are there. So in an account you can record a transaction either in the debit side or in the credit side. But you have to record a transaction in the debit side of one account and the credit side of another account. This transaction, this particular transaction is to be posted in the debit side of purchase account and the credit side of cash account. Why it is like that? That we will study in further session. Here, look how the posting is done. In purchase account debit side, January 10 date is shown, then particulars column, cash account is shown with the precinct 2. Look, in purchase account what is shown is cash account. So in one account you will show the name of the corresponding account in particulars column. Here in debit side with the precinct 2. In cash account, look at cash account credit side. The transaction is shown under credit side as by purchases. In particulars column is by purchases. That is, in cash account you will show purchases. In purchase account you will show cash. In one account you will show the name of the corresponding account. Yet particulars entry in the debit side will start with the precinct 2, proposition 2. And on the credit side of cash account, it starts with the proposition by. Why this 2 and by? You will understand if you refer to the passbook, bank passbook, in which there is only one particulars column. All what we enter in the debit amount column, you will start with the proposition 2. All the entries that you have to record on the credit side, credit column of the cash book, you will start with the precinct by. This is how ledger posting is done. Now look at the folio column, journal folio column. See, number 1 is shown. On credit side also same number 1 is shown. This means this transaction is taken from folio number 1 of the journal book. Okay, further we will study in next lecture. Now the question is, how is it to decide that in a transaction of purchase of goods for instant cash payment, purchases account is to be debited and cash account to be credited? How to decide the debit aspect and credit aspect of transactions? We will study that in lecture 2. Finishing today. Thanks for your serious participation. Please subscribe, like and share to all your friends and relatives.